Welcome to the program. My name is Marty Schenkman. I'm joined by two well-known, very bright colleagues, Jonathan Blotmacher and Bob Keebler. Bob Keebler is a nationally known CPA with Keebler and Associates out of Wisconsin and a very smart guy. He's also the most dapper of us because he has a tie and a jacket. I wore the jacket, Jonathan wore the tie. So together we almost equal Bob. And Jonathan, I don't think needs more introduction. He's involved with a million different things, but including Interactive Legal, Peak Trust Company in Alaska, Nevada, and Pioneer Wealth in New York City. So let's get going. We have exciting, really important stuff to talk about. Golly, it's a new day, and we have new things to talk about in the tax world. It seems like change is the constant. Couple of quick webinar pointers. The PowerPoint will be available for download on the web console. If you look at the tab that says handouts, you open it up and you can download it. We'll post a recording of this and the handout materials on Schenkman Law in the webinar section. Interactive Legal, Vanessa, I believe, also posts everything. So you can go there. And I think Peak Trust posted on their website, Jonathan. Nicole, is that correct?
That is correct.
Okay, so lots of places you can get everything, no issues. There's a growing library of webinar recordings on the Schenkman Law website. We probably have 60 webinars you can download anytime. Probably half of them are with Jonathan and Bob, but forgive me for that. And a growing library of video clips on Law Easy. We don't give out CLE, but we do issue a certificate of completion if you can self-report. If you have any questions, the best thing to do is email the panel. You'll see at the end of the slide deck, Jonathan, Bob, and my email, and we'll all try to help and get back to you. Don't put questions through the Q&A on the panel, on the console. It's just too difficult to address that during the course of the program. So we have three quick sponsors, and I will ask Vanessa to kick it off.
All right, thank you, Marty. Thanks everyone for joining us, and welcome to 2021. I'm Vanessa Kanega. I'm the president of Interactive Legal. For those of you who aren't familiar with us, we provide automated drafting software and other resources for estate planning and elder law attorneys. This year potentially brings abundant change in the estate planning arena. So we are very happy to sponsor this program. And I'm sure Marty will continue to bring you more education. We will also continue to bring you more education and resources as things progress this year, in addition to the provisions and documents in our software. So if you'd like information, please feel free to visit our website at interactivelegal.com or email the sales address that you see on your screen right now. Thanks very much.
And as a plug for Interactive Legal, Jonathan and I think others from Interactive, including Vanessa and others, have put together some sample language for the formula gifts. That's probably one of the most important things to think about in 2021 planning. We're going to talk about it. Jonathan and Interactive are gracious enough that I'll add it to the PowerPoint that you'll have, and thank Interactive for being so gracious. Our next sponsor is Peak Trust, and we have Nicole King on the line, who's going to say a word or two.
Hi, thank you, Marty. Welcome, everyone, and Happy New Year. My name is Nicole King, and I'm a trust officer with Peak Trust Company. We're pleased and honored to be able to sponsor this very important presentation today. I'd like to take this opportunity to tell you a little bit about Peak Trust Company. We serve individuals and families and their advisors by offering a tax-favored situs in either Alaska or Nevada. We are a full-service trust company, and we offer flexible and customized administrative services for all types of trusts. If you should have any questions, please do not hesitate to contact myself or any member of the Peak team. Our contact information can be found in these materials as well as our website. And with that, I turn it back over to you, Marty. Thank you.
And just another plug for Peak. They were absolutely amazing. We were doing something like a gazillion trusts last year, as all of you were, and Peak was working 8 days a week and turned things around in record time for us on every client matter. So thank you to Peak. It's my custom that every webinar I do, I take a couple of minutes and let a different charity each time introduce themselves to you. It's a wonderful way to hopefully help each of you see some of the great causes out there that you can help, and to keep in mind for clients that may be interested in making donations. The American Brain Foundation, the ABF for short, is close to my heart, a wonderful organization with a great mission, and we're fortunate to have the Executive Director, Jane Ransom, who will say a few words.
Well, thank you, Marty, and we're fortunate to have you as one of our members of our Board of Directors, so thank you for that. The American Brain Foundation is a national charitable organization funding medical research on brain diseases and disorders. And our vision is life without brain disease. And I don't think it would be a wild guess or bet that all of you on this call today, on this webinar, have been touched by brain disease, whether it be a grandmother with Alzheimer's or a spouse with MS, a child with sports concussion, or a coworker with epilepsy. There are 400 brain diseases and disorders. We collaborate really closely with the American Academy of Neurology, our research partner, and the world's largest association of neurologists. Their scientists select all of the research that we fund so that we are sure to be funding the best and brightest researchers in the world to try to crack open and find cures for brain diseases and disorders. The American Brain Foundation is a great one-stop shop for donors whose families have been affected by multiple brain diseases, as many of us have experienced. And we have the structure to establish donor-advised funds for research on single specific brain diseases as well. So thank you so much for your time today. Feel free to contact me anytime about how we can bring donors together with researchers to cure brain diseases.
Thank you, Jane. So let's get into it. So not so long ago, it feels like we were talking to all of you about what you better get done and try to get done for clients and how to help clients at the end of 2020 because we had no idea what was coming in 2021. I must admit, and I don't know if Jonathan or Bob felt differently, but I was skeptical whether the Democrats would be able to get both seats in Georgia, but it turns out they did. And that will undoubtedly have a significant impact on the tax landscape that we are dealing with and clients are dealing with. And that significant impact is what we're going to talk about. And specifically, what do we tell clients now? What do we do now? And a lot of the materials in the slide deck are similar to some of the planning ideas and materials we gave you last year at the end of 2021 with some of the techniques and tools you may want to use. But what we're going to focus on today in the hour that we have is really more of an overview and introduction, and most specifically what you need to do differently. And we're also going to have Bob Keebler address a bunch of the income tax changes, because even if you're focused as being an estate planner, the income tax changes are just dramatic, and Bob may think dramatic understates the case. So I'm going to have Bob go through a bunch of the income tax changes, and Jonathan and I and Bob will help are going to talk about some of the unique nuances right now that are different than what we had talked about for 2020. And Bob and Jonathan both agreed that we will do some further follow-up, longer, in-depth programs on some of the topics that are really relevant to helping you as practitioners and helping clients understand what they need to do. And we'll follow up with at least 2 sessions, hopefully, that we'll call deep dive programs, and maybe take a segment of this that we may have spent 5 or 10 or 15 minutes on and spend an hour on it. So Biden is the president-elect, the House is Democratic, and at this juncture, we know the Senate is 50-50. Jonathan, 50-50 Senate, what does that mean to tax legislation? What do people, what should they anticipate for their clients and taxpayers?
Well, Marty, there are 2 key elements. Number one, the Senate has a rule that any bill can be filibustered unless you get 60 of the senators to say it can't be. But there are a few areas where there can't be a filibuster, and one is with the Budget Reconciliation Act. That's been around for about 40 years, And in fact, George Bush wanted changes in the tax law beginning in 2001 when he took office. And he had a Budget Reconciliation Act. But like today, the Senate was split 50-50. But Vice President Dick Cheney then got to cast the deciding vote. And that will now happen with Kamala Harris. So just like Dick Cheney was able to cast the deciding vote, so we got the Tax Reform Act of 2001, which George Bush wanted. And one of the things you might remember is there was a limited life to that because it cost so much. With what Biden is proposing, there's probably going to be an increase in taxes, so that changes would be permanent again, unless they're changed by another administration and another, both House of Representatives and Senate. So with Kamala Harris, they can get these changes through, assuming that they get all 50 Democrats to vote in favor of what they want. There's a lot that's going to be changed, and we're going to talk about that. But politics being what it is, people may balk and they will make deals along the way. So we can't be certain even of adopting all the things that Joe Biden says he wants in a new tax bill.
But Jonathan and Bob, because this is really the key question, do either of you doubt that we're going to have significant tax increases? I mean, aren't you both pretty confident we're going to see major changes, even if we can't predict what it may be? And, you know, whether the exemption is 5 million inflation adjusted or not inflation adjusted, 3.5 million, don't you anticipate significant change given the composition of Congress and the White House now?
I think it's more of what will be the effective date. We know things will change. The easy things are the estate tax exemption is probably too large by Democratic standards, and the income tax rates are too low by Democratic standards. And then there'll be other things along the way that people look at and try to make adjustments to, both to enhance the income tax revenue collections and to enhance estate tax, gift tax, and GST revenue collections. So no doubt there'll be changes, Marty.
And one of the things, Marty, that I think is going to be a little different is Biden is not proposing to increase taxes on the less wealthy in the United States. It's only at the upper end, and Bob is going to talk about some of the income tax changes, and those things actually provide the government with more money, which means you can reduce the taxes on the lower level of wealth and the lower level of income in the United States. And as surprising as it may sound, if you lower the rates on people in the lower sector of the country, the economy will actually expand. And the reason is that people who make less money spend a much larger proportion of their income than wealthy fellows like you and Bob do, Marty. I'm going to guess that you and Bob make so much money, you probably don't spend 20% of your income each year. But if you've got somebody, say, on minimum wage, I have a son who's on minimum wage, he spends every penny. And if you gave him a tax cut so he had $10 more a week to spend after tax, I know what he'd do with it. He would spend it immediately. Whereas you, because you already have as many Porsches and Cadillacs and yachts and planes as you guys want, you won't spend it, you'll save it. So this is a plan that I think could turn out very well, and I'm sure the Democrats are going to say it's going to aid the economy. It's not going to hurt it with these tax cuts, because it's going to be focused primarily at rich people like you guys.
Well, Jonathan, when Bob and I really make it, you know how we're going to know we're really successful and we've really made it? When Bob and I can afford to hire you as our attorney, then we know we've made it. So I think there's a couple of points that are very important. All three of us are pretty confident we're going to see significant change. It seems pretty clear that the changes, especially the restrictive changes in terms of tax increases, whether income, estate, whatever, are going to be at the higher end of the spectrum. But the reality is our professions, respectively, really serve people at the higher end of the spectrum, because those are the people that have the need for our services. So we may see the lion's share of all of our clients very adversely affected in terms of taxes. And there's another piece that I want to add on. Bob made some good points, as did Jonathan, about revenue raise from increasing taxes. But there's another component to it, and that is the social agenda and the impact on society of trying to dampen wealth concentration, which has gotten dramatically, from what I've heard, and I don't have any statistics, but it certainly appears to have gotten worse or exacerbated during the COVID situation, when so many people on the lower end of the wealth and income spectrum have had their jobs lost, whereas people on the higher end of the spectrum tend to have more money in the market. So from a social as well as revenue raising perspective, we all anticipate significant changes. On the bottom of slide 9, the third bullet point, we talk about some of the techniques, and many of the techniques that you want to use now are similar to the techniques or identical to the techniques we talked about using for clients at the end of 2020. But there's some very significant differences in the brief time we have. That's what we're going to speak to. Bob kind of let the cat out of the bag, so to speak, by saying we don't know what the changes will be for sure, but the really uncertain thing is, when will those changes be effective? I think we all agree that we anticipate significant tax increases, but when will they be effective? And those effective dates will affect what we all need to tell clients, what we all need to look at doing. So the issue is, if we don't know the effective date, what do you do? And I think one of the real key points for advising clients what to do is, we all have lots and lots of clients that just did not act in 2020. They either just didn't believe the changes would go through, they didn't believe that the Democrats would get sufficient control, they just didn't want to deal, get more tax planning. Whatever reasoning they had, I think it's important to contact those that didn't do all the planning they should, didn't complete planning, but especially those that didn't pursue planning, and educate them to the point that, hey, this really may be the last opportunity to do significant planning before major changes occur. And those changes for the well-to-do and the higher income people are going to be rather unfavorable. And we can't, and this is very important, and I have a section coming up that we may chat about a little in terms of protective steps for practitioners, but it's very important to make sure clients understand any planning that you undertake now may be of no benefit at all. It may be for naught, because if the tax changes are retroactive, and we're going to talk about that, the planning that we finish by February may be completely irrelevant. So that's something that's really significant to address. So on slide 12, these are some of the goals, and I put as number 1, protection from retroactive tax changes. And I'm going to have Jonathan and Bob both speak to that. We're going to offer you some very specific suggestions on that. And I think that's really one of the most important pieces of what we need to talk about in this program, what retroactivity means and what we can do to help protect clients. The second bullet point on slide 12 is something that, if you heard any of the programs that we did last year, especially at the end of 2020, we emphasized, and it remains a critical issue. Unless clients are very, very wealthy relative to the exemption amount, and even if they are very wealthy relative to the exemption amount, preserving access is critical. And that's going to help determine the techniques you use, how you apply them, and how much is transferred. Using exemptions is critical, and we're going to talk more about that, because, as I forgot if it was Jonathan, Bob, one of us said, reducing the exemption seems a very likely target. Asset protection, wealth tax, we don't know that there won't be a wealth tax proposed. Maybe, we'll see. Slide 13, just a general point. I think it's really important when you're helping guide clients that you have the financial advisors, insurance consultants, wealth advisors create forecasts or models of what they can afford to transfer. If a client feels, and many clients feel concerned, gee, if I'm worth 20 million, but I transfer the 11.7 million to use my exemption, will I have enough to live on? And it's much better to quantify that with Monte Carlo simulations based on real budget and lifestyle expense numbers than to permit a client to go on gut feel. Some clients, the gut feel, and I find this to be the small minority, is such that they'll give away more than they should. But I find a very large number of clients become uncomfortable making large gifts to use exemption, even if they have a substantial estate, because they just fear they're not going to have access to sufficient money. Looking at insurance is certainly something that should be done in conjunction with that. So if you're doing non-reciprocal spousal lifetime access trust and there's a premature death, you want to make sure that insurance or other mechanisms to reach and have access to that trust are there. And as I've always tried to emphasize in the bottom of 13, the team approach is certainly the better way to go. Let's talk a couple of comments quickly, and then I'm going to ask Jonathan and Bob to comment on the retroactivity. We need, as practitioners, to be careful. I think getting models, forecasts, insurance projections is very helpful to assure clients understand what they're facing if you're doing planning now. Insurance may make a world of sense, because if you're, I didn't even think of this until now, but if there's a retroactive tax change and the planning that we're undertaking doesn't work, client may be at least better off if they purchase life insurance, so at least something has been done. One of the things that we had a lot of talk about last year was for those that were uncomfortable making transfers of hard assets, of actual assets, to make a gift of a promise. And that still may make it may make sense for some clients in limited circumstances to look at. But I think when a client is uncomfortable, and this is different, and I think we have a difference now that's important to point out. Last year when we lectured, we talked about if a client was anxious to have the ability to unwind the planning, that you need to be careful as a practitioner, because does that suggest that the client is uncomfortable making the transfer, and no matter what you do is not going to be happy with the planning? And we don't want to be in a position where a client perceives us as pushing them to make transfers that are greater than what they're comfortable doing. But some of these same mechanisms that we talked about using to unwind a transaction because a client was uncomfortable, we're going to now talk about in a different context and for a different purpose, and that is dealing with retroactivity. Slide 17 lists some of the steps that you may want to take to help protect yourself and the client from possible challenges. Now, slide 18, I want to turn it over to Jonathan and maybe Bob as well to comment. And this to me is really one of the most important things. And this is different than what we did last year. Last year, I don't think anybody had any concerns that we'd have a tax law passed sometime in 2021 that would be retroactive back to 2020. I think we were all pretty confident that if our clients finished planning by 12/31/20, they should be pretty set in the planning. Now, again, they may make some of the tax law changes apply prospectively that could catch and ensnare some of the planning we did last year, but we weren't concerned about retroactivity. But this year, we're very concerned. And I'm going to let Jonathan and Bob talk about this and take your time, because I think it's that critical. What is the possibility of a retroactive tax change? Is it legal to do? And then most important, I'm going to have you discuss some of the steps to take, like the formula transfers, to help protect clients if there is a retroactive tax change. Jonathan?
Well, there's certainly, in many cases throughout our history, the Congress and the President have enacted tax changes which either take effect immediately and some are retroactive to the beginning of the year. There are two cases there, the Pension Benefit Guaranty Corporation versus Gray, and then the more recent case called Carlton, which dealt with an estate tax change, which was made not just retroactive to the beginning of the year, it was made retroactive to a prior year. And there was no warning that that was going to happen until it really did happen. But the Supreme Court said it's okay. And the Supreme Court has said Congress can make these changes retroactive, even if it's only to raise additional revenue. So that's a possibility. I think as a general matter, they probably are not going to make a lot of retroactive changes. I mean, some of the things that are being considered is a repeal of Section 1031, the like-kind exchange rule for real estate. There's been a push to get rid of that. Will it happen? Possibly. I don't think it will be retroactive. You can't tell for sure. The one thing that might be retroactive is a reduction in certain income tax rates for the poor, because so many of them have lost their jobs. And Congress will come in and they're going to pass some sort of additional payment above the $600, which Congress approved at the end of last year. But they also might just say, well, if we're going to retroactively reduce the rates to the beginning of 2021, so the poorer Americans get more in the way of tax relief, larger refunds, less withholding, we need to offset that by increases on the other end. So that certainly could happen. Estate and gift tax changes, I do not think by and large they will be retroactive. They might decide that they will change the exemption down to say 5 million or 3.5 million, which is something that's been bandied about. It could even be a million or possibly lower. I don't think that will be retroactive to the beginning of the year. But if they decide to do it, that they're going to do it, say, mid-year, say they get this thing passed on September 30, 3/4 of the way through the year, and they say, as of this date, we're going to have a change in the exemptions, that's a little bit more difficult to deal with in a calculation of tax setting. Bob, what do you think might happen?
Well, remember, estate tax returns are due 9 months after a person dies. So it creates a very difficult situation to make something retroactive more than 9 months. So on the income tax, not due till April 15th of the following year, but the estate tax, gift tax is April 15th too, but on the estate tax side, you kind of have that awkward situation. My guess is they draw a line in the sand of either 1/1/22 or on the day it's introduced into Congress. And that's probably what happens. At least I hope so. It'd be very unjust to go back and change it effective January 1st, because undoubtedly, if they did that, I would hope they would try to find a mechanism to allow people to undo their transactions. But the problem is Congress doesn't control state law, Jonathan. So if I made a valid gift under state law, how can Congress give me the authority to undo that? So I think we have to pay very close attention to this. And I know you've drafted up some wonderful language using Wandry in a fraction that will give us probably a result that would allow us to protect our clients.
So it sounds like I kind of agree with what Jonathan and Bob said. I'm not. I don't anticipate that they're going to have a lot of retroactive changes on estate tax matters. That being said, why take the risk? So if a client is making an $11.7 million gift, that's a lot of money. And if they're making a transfer and the new exemption amount is reduced to 5 million, maybe not inflation adjusted, or 3.5 million, or the gift tax exemption has been talked about being reduced to 1 million. Why complete that kind of transfer without building in a mechanism to undo it or cap it so that the taxable gift component is limited to whatever the new exemption amount would be? Do you guys think that that's really going to be the norm for planning now?
Well,
early
Marty,
2021?
Well, Marty, I think a lot of people will try to get under the reduction in the exemption if they think it's going to happen. And Biden has said he wants it to happen. So people, and that's going to happen presumably not later than the beginning of next year. So if you want to preserve more of your wealth for your loved ones, you're going to have to give away property this year. And one of the things that is not well known is that you can't give away just part of your exemption. So if you think, well, I'm pretty sure they're never going to lower the exemption to below, say, 3.5 million. So I'm going to give away 8 million right now. I'll make a gift of 8 and I'll preserve 3.5. The Treasury has indicated you can't do that. The way they think the law will be, if you die with a smaller exemption, that exemption that exists at a later time of gift or at death will be first applied against prior gifts you've made. So if you want to use part of your $11.7 million exemption, you've got to use it in full today. You can't use it in part where you're just not going to be able to preserve it. That's very, very important to know. The question is, so now I'm compelled to give away 11.7 million, my spouse the same if I'm married. There are two questions. If I have the assets to do it, but I want to obtain a benefit in it, because you should say, Marty, you know, even if you're really rich today, like you guys are, maybe your financial fortunes will turn against you later in life, and you wish you still had access to that $24 million which you and your wife gave away. So one question is, how can you do that? Number two, If they're going to make a retroactive change and take away my exemption retroactively to the beginning of this year, I don't want to have to wind up paying gift tax on millions of dollars, because if they drop it, say, from 11.7 to 3.5 million, I'd have to pay gift tax on $8.2 million. I don't want to do that. And one of the things that Marty has right here is to consider using a disclaimer. A very simple way to do that is just to say you have one child, you trust that child, you don't like trust, and if you don't like trust, you might as well end this seminar right now, because it's the most powerful thing you can use for people. But let's say if you give it outright and your child disclaims it, it's going to revert back to you, and that's fine. But almost always you're going to want to use a trust, and the question is, how can you get it back if it's in trust if you're not a beneficiary? Well, the regulations under Section 2518 make it abundantly clear that when you have a disclaimer provision, you do not have to have the disclaimed property go the same way that it would if the principal beneficiary dies. So if I create a trust for my wife and I say when my wife dies, it continues in trust for my kids, if you don't do anything else and my wife disclaims, it will then go to my kids. But you can provide, and the regs are very clear on this under 2518, that I can have a different transfer if my wife disclaims. For example, very often you'll have it go into another trust for your spouse. For example, if you create a marital trust and your spouse disclaims, it'll go into a family trust. But you can also provide for it to revert to you. So you say, my wife is the principal beneficiary of this trust. It's not a marital trust. It's a non-marital trust because you want to use exemption. And if she goes ahead or he goes ahead and makes the disclaimer, the disclaimed assets you will provide will revert back to the donor. And whether you're married or not, if you name a principal beneficiary and you authorize that beneficiary to disclaim any assets donated to the trust, with a provision that to the extent of the disclaimer, it will revert back to the donor, the client has no downside if the client believes that her spouse or child or whoever you name as the principal beneficiary will cooperate in the event that the client wants to undo the transfer because they don't want to pay gift tax on the excess above the reduced exemption. So that's something that you can put in there. I have language in Interactive Legal to do that. You can generate your own if you want to, but it's a wonderful thing to say to your client, look, we can go ahead with planning and you really don't have to worry about a retroactive change because there's a disclaimer. Now, if you did the trust today, you'd have 9 months. You'd have until October 9th of this year to do the disclaimer. If you want to do even more, you could put one of your minor children. Let's say you have an 18-year-old and you say that 18-year-old will be the principal beneficiary of the trust. Then under Section 2518, that 18-year-old has until 9 months after her 21st birthday to disclaim. And that you can do. Or you could go to court and have a guardian do it. In fact, she's an adult. She could probably do it herself. Even though she's an adult, 2518 says she has until 9 months after her 21st birthday, as long as she hasn't accepted benefits. So that's something you can do. So that's something that I think you ought to consider putting in your documents, this disclaimer that results in a revesting of the donated property back to the donor so your client feels more comfortable.
And I think and again, I know I'm repeating myself, but I think this is just one of the most important points of the whole program. I don't recall a time in my practice where we would say maybe every trust you do, almost every trust you do, you may want to put in the disclaimer provision Jonathan said. But because of the uncertainty of what if they do make a retroactive back to January 1, Bob pointed out that state law may not permit a undoing of the transfer because state law will govern property rules. But if you put in the disclaimer that Jonathan said, it at least gives you a fallback position that if you consummate a gift in February or March of an $11.7 million exemption, a lot of money times two if it's a married couple, and it turns out they lower the exemption retroactively to January 1, you don't have to worry about what they provide in the law. If anything, they may not. It gives you a way to undo that transaction and avoid the tax. I mean, I would like to think they're not going to pass a retroactive change reduction in the exemption and cause people that in good faith made a gift based on the known exemption when they made it in, say, February and the law was passed in July to saddle them with the tax. But why take that risk? put in the disclaimer. It's adding another provision to your trust. Jonathan, one of the other ways, and Bob, you may want to jump in on this, that you can try to mitigate the problem of a retroactive tax change is by making a transfer to a QTIPable trust. Perhaps, Bob, do you want to talk about that, or Jonathan?
Well, I can jump in here, Marty. The first thing, backing up half a step, if we use any type of quandary or overflow clause, it's critical for the CPAs doing the gift tax returns to disclose that, because read what the arguments the government had in quandary. They really went after that CPA pretty hard that he didn't fill out the gift tax return correctly. It's about the statute of limitations. What you don't want to find out is that somehow the statute didn't run 20 years from now because you didn't disclose correctly on a gift. Remember, the government has an FSA out there. I just want to show you how nitpicky they are, where someone only used 8 of 9 digits of an EIN number, and because of that, they said the statute didn't run. So definitely, we always try to disclose, not only in the return, but in the attachments. We'll put those deeds of gift in there to make clear exactly what they said. Now, QTIPs. So here's the deal. I gift $11 million to a QTIP trust for my wife and children and grandchildren. We allocate GST exemption, the whole thing. Along comes a retroactive change. I initially thought I wouldn't make a marital deduction election, Marty. I thought I would just burn up exemption to make that gift. But now you tell me as my lawyer, hey, Bob, you only had $1 million exemption when you did this. You need to make a QTIP election of $10,700,000, a marital deduction election. So I made an $11.7 million gift. Absent the election, I would have to pay gift tax on that. Because of the election, I receive a marital deduction, and now I pay no extra tax up front. Now, that's half the story. The other half of the story is that election can be made on an extended gift tax return. So you could actually not make this decision. If you made a gift today, you wouldn't have to make that decision until October 15th, 2022. October 15th, 2022. You could wait all that time to see what exactly was the best decision for your client. So I think the QTIP has some merit, has to be implemented very carefully, and the lawyers and CPAs are really going to have to coordinate this to make sure those gift tax returns are done perfectly.
Also,
Again,
keep in mind,
one second, Doug. Keep in mind
that your spouse has to be a U.S. citizen in order to do this. If you're married to someone who's not a U.S. citizen, you can't do it. There's, retroactive relief if you make a transfer to a non-citizen spouse at your death, but you can't do it for gift tax purposes. Now, your client is obviously going to know if she's married to an American or not, but you may not know. So you need to ask that question before you say, hey, let's have you create a QTIPable trust for your spouse. And to the extent the exemption goes down, we'll merely elect for it to qualify for the marital deduction. So we don't have to pay an additional tax. If that spouse is not a U.S. citizen, you just can't do it. You can't get the marital deduction. Also keep in mind, and this is critically important to remember, you can only elect QTIP treatment for a lifetime transfer if it's on a timely filed gift tax return. If you're 1 day late, you're barred from doing it. And I've tried to get that changed with a few friends, but they haven't bought onto it yet. So if for some reason you didn't tell your accountant that you made this trust, your lawyer knows about it, but your accountant is filling out the form, your accountant doesn't think you've made any taxable gifts that got you on an income tax extension, if you don't file in the time prescribed for lifetime 709 gift tax returns, you can't make the QTIP election at all.
Jonathan, one of the other things that I think we should just quickly comment on is Clayton. Clayton is a mechanism to have the executor elect marital trust treatment, and if not, then the assets would flow to, say, a family trust. But Clayton is, I believe, only viable on an estate, it doesn't work for gift tax purposes. Is that correct?
That's correct. Someone came up with the notion that I'm going to create a QTIPable type trust, but to the extent the executor, remember with a transfer of death, it's the executor who makes the decision whether or not to elect QTIP treatment, marital reduction treatment, provided that to the extent my executor does not elect QTIP treatment, then it will go into a family trust. The IRS took the position that even if you did elect QTIP treatment, you had a bad marital deduction provision, because a QTIP must provide for all of the income to be paid to the surviving spouse for life, and no one can allow anybody, even the surviving spouse, can't be given a power to let anybody else enjoy the property during the rest of the life of the beneficiary. So the IRS said you have a bad marital deduction trust from inception. There were a lot of court battles, and the IRS finally said, okay, what we'll do is we will allow this for estate tax purposes. And a Clayton QTIP can be a very powerful thing where you're not sure how much you want, whether you should have a full marital deduction or only partial, or property going in. You can do it, and the executor can wait until the estate tax return is filed, and to the extent that the executor does not elect for QTIP treatment, then it will go into a family trust. They have not allowed that for gift tax purposes, and I am confident that they would fight it tooth and nail. In addition, think about it, you probably have an incomplete gift. I've created a trust for my spouse. I'm the one who has to make the QTIP election or not. It's all up to me. I'm the donor, and yet I can prevent my wife from getting the income interest. I can have it go into a family trust. Well, you know what that sounds to me, guys? It sounds like it's an incomplete gift. I can change the way it is. And the regulations under 25.2511-2 say if I can change the shares of the beneficiaries, then the transfer is incomplete. So you've got the worst of all possible worlds. Unless you get your own private letter ruling, and I don't think you're going to get one, and if you try to get one, and even if they rule, I think it's going to be too late for you, I would not try a QTIP lifetime trust. I just think it's going to be a mistake.
So we've talked about two mechanisms to address the risk of retroactivity. One was a disclaimer built into a trust where a trustee or beneficiary, primary beneficiary, can disclaim. The second is making a transfer to a QTIPable, QTIP-like trust, and then deciding by the extended due date of the gift tax return whether you're going to make a marital deduction election or not. The third and final one, Jonathan has done a lot of work on this, so I'm going to let him comment. But these three techniques really need to be thought about, I think, in any large transfers you're doing that could be using exemption that could otherwise create a gift tax if the exemption is retroactively lowered. Jonathan, why don't you talk about the formula approach as the third mechanism?
Well, you all know it's extremely common when you're representing a married person to say that her estate will go into two shares. One share will be equal to her unused estate tax exemption, and the balance will qualify for the marital deduction. There's no reason that can't be done during lifetime as well. In fact, there are numerous cases where it can be done, and you can do it by word formula. You can say, I leave an amount equal to my unused estate tax exemption, which you would define, to go into a family trust, and the balance to go into directly to my spouse or into a marital deduction type trust. Or you can do the reverse. You can say, I want the minimum amount necessary in order to reduce my federal estate tax to zero to pass in a form qualifying for the marital deduction. The balance you'll have into the family trust. You can do that. You got a lot of choices on how you set it up. And it seems you ought to be able to do it during lifetime as well. So you can make a transfer and say, I want an amount equal to my estate tax, my remaining gift tax exemption to pass into a family trust, and the balance to pass to my spouse. And that's very good for a couple of reasons. Number one, you may have an asset where you're not sure of its value. You've got, say, a piece of land, you've got closely held stock, you've got a work of art, and you want the amount of that, a fractional share, and you gotta make it a fractional share of that to go to the family trust, the amount of the remaining gift tax exemption, and the balance to pass to your surviving spouse. Or if you're not married, maybe you want it to go into an incomplete gift trust, or some people think you ought to have it go into a GRAT. Now, I could spend an hour talking about why GRATs are more challenging than an incomplete gift trust, or easiest of all to a marital trust if your spouse is a U.S. citizen. That's very easy to do. But that's what you want to do. You can do that. And you just use the same words essentially that you would in someone's will or irrevocable trust to take effect at that time. And, you know, it's not even a Wandery type formula, but the courts have been extremely accepting. I mean, there's the Petter case, there's the Christensen case, there's the Wandery case, where they basically said you can give a fractional share where you say what the numerator is. You get an appraisal saying this property is worth $7,423.16. That will be your numerator. The denominator will be the full fair market value of the property. Now, what I've done, and you will receive
for gift tax value is finally determined.
For gift tax values. And Marty, as you point out at the bottom here, I think somewhere for the Nelson case, they failed to use the phrase as finally determined for federal tax purposes, and the court wouldn't let them do it. So make sure you do it the right way. So make sure you do it the really the right way. Be conservative on it. Now, one of the things I've also done, and this will be in the language you get, I say I'm going to give the amount of my remaining gift tax exemption determined under the credit under section 2505 of the Internal Revenue Code as in effect this date that I'm making the transfer, including any retroactive changes. So I think today I've got an exemption of 11.7 million, but if Congress later changes and said, no, we needed the money, whatever reason, we're going to change it to 3.5 million or 1 million or 5 million later in this year, but retroactive to the date of this transfer, I have that built in. Now, I've had a couple of real neocon colleagues of mine say, you can't do that. You can't do that. That's cheating. I don't think it's cheating at all. I cannot imagine the IRS or a court saying, well, you didn't know what it was. You were trying to comply. Congress later changed it. You didn't retain any power to change it, but we're going to say you can't do it. You're going to be stuck with a retroactive change, even though you said, I only want to use the exemption that is finally determined under federal tax law, including retroactive changes made by the Congress and the president to apply in determining the amount of the gift that I've made. Now, as we were talking about before, if something like that comes out in legislation, make sure you have that built-in disclaimer so you'll have a second bite at the apple. So if they say, nope, you're stuck with having made a transfer of $11.7 million because on March 1st, when you did it, you thought that was amount. And yes, you said, well, I'm going to take into account the retroactive changes that Congress and the president make hereafter. We won't let you do that, but you can do it by disclaimer. So build them both in, and I think you should be golden.
So Jonathan, my deed of gift carries a formula clause with retroactivity. And then if somehow that fails, when it gets to the trust, you would still have 9 months to do a disclaimer. And that would unwind your gift. Or you could, the trust could be a QTIP trust too, I guess.
Right. Well, QTIP, Bob, as you have pointed out, is the most flexible of all because you're going to have until October of 2022 to determine how much marital you want and how much marital you don't want. Right. But I think the boys and girls out there who are saying you can't write a formula where you say that I'm going to use the exemption. They say, yeah, you can use the exemption. You can say whatever the exemption is, but they won't let me take into effect later changes that Congress and the president make that are retroactive to the date of the gift. It'll never happen politically. I don't even think the service would even try. And I don't think the courts will let them get away with it. But again, consider the disclaimer as a backup. Consider a QTIP trust as a backup, and you should have plenty of time. I think we will know by this summer what the major proposals are. And Marty, maybe we ought to go along and talk about what some of those changes might be.
The key take-home point is what was just discussed is different than how most of us ever executed lifetime transfers in the past. We rarely, I can't remember when, were concerned about the possibility of a retroactive reduction in exemption. Now we're concerned about it. So we've just given you 3 discrete ways, and you can use some of them in combination, to protect a client who makes a transfer. So before you consummate a gift plan, and I think we all want to talk to all of our clients about the potential now that the Georgia election is over and it's a 50-50 split and the Democrats can push through changes they want, we should all talk to clients about planning. I think most of you know what to really say. Use exemption, lock in discounts, and so on and so forth. And we'll do a deep dive program where we'll spend 2 hours about the estate tax changes within the next 3-4 weeks. That being said, what was just discussed is different than anything we've ever done, and I think it's really important to focus on. What I want to do for maybe the next 20 minutes, 15 minutes, whatever you need, Bob, is turn it over to you, and I'll just advance the slides as you tell me to, and let you talk about some of the income tax changes that are on the horizon, because these are significant, and we all need to give thought to these as well.
No, thank you, Marty. Now, the changes from the Biden administration would be focused on couples and individuals earning over $400,000. There'd be an expansion of the Social Security tax. There'd be a restoration of the 39.6% rate. The value of itemized deductions would be capped at 28%. We would restore the 3% P's limitation, and Section 199, the benefit of that would be further reduced. So let's look at page 26, please. Now, the one important thing is capital gains when you're earning over $1 million would jump to 39.6. So if, Marty, you earned $999,000 in your practice, but had a capital gain of $10,000, $9,000 of that capital gain would be taxed at 39.6. The other possibility, which goes way back to over 40 years ago when Jonathan wrote the book on Step Up and Basis, we're going to end up with either with some form of with the step up being taken out of the code. Now, how big the de minimis amount is, no one knows right now. Now, we just have to hope we don't go to a Canadian system where there's gain realization at death, because that would mean that not only wouldn't you get a step up, but when you die, the income is either going to end up on a 1040 or on a 1041 effective on the day you die. And that tax would have to be paid. And if we end up with a state tax and income tax on the same asset at the same time, that is going to be a very, very expensive proposition. The objective to really beat the income tax on over $1 million, when you have over $1 million of income, to beat the capital gain tax, will be to smooth out capital gain income. So we're all going to become very smart at 453 installment sales, shared remainder trust, opportunity zones. If 1031 exchanges survive, we're going to, a year from now or a year and a half from now, every one of our friends on the call today will have 3 or 4 times as much knowledge of how to smooth out income. And it's going to be, the estate and trust lawyers are going to have to learn this very quickly, because things like CRTs or 453 installment sales to non-grantor trusts, we as CPAs will be designing those, but we're going to need someone to draft up those documents. And the logical place is to go to T&E attorneys who are already knowledgeable on those type of trusts, than to have to go to income tax attorneys necessarily that aren't familiar with grantor versus non-grantor trusts. So, or CRTs perhaps. Let's jump up to page 27. For people, and Jonathan brought this up earlier, but for people towards the bottom of the market, there will be changes to the tax law designed to increase their cash flow. And that might be in the area of the child credits, ACA credits, earned income tax credits. Those are things we're gonna have to watch to see how they affect some of our clients. Okay, 28, please. Now, here's the scary thing. Right now, this year, if one of your partners earns $142,800, they pay Social Security taxes to the top of that. If they're sole proprietor, they're going to pay 12.4%. But then there's no more Social Security tax, period. You could have $1 zillion of income, you won't pay any more taxes. The Biden administration proposal would say up to $142,800, you pay the tax. Then you have a holiday up to $400,000. Then you turn around and you pay the 12.4 on everything over that. So Marty, if your physician earns exactly $1 million, she would pay 12.4 on the first 142.8, have a holiday up to 400, and then the 12.4 would start again. Now, you may want to use S corporations to avoid this, but in all likelihood, Congress will eliminate how we structure S corps to achieve that goal. Let's go up one more slide.
Just to clarify what Bob is saying is many people would have like a professional practice structured as an S corp, pay themselves $2,000 a week or whatever the number is that is deemed reasonable compensation, and pay Social Security tax on that. And then the excess over what's reasonable compensation would simply be deemed to be a distribution that would not be subject to Social Security tax. And that's the loophole Bob said they may close. And I think he's right, because that is something that many professionals have used for a very long time.
Now, if we go up to slide, let's go up to slide 30, please. Now, the 39.6% rate would come back on income over 400,000. That is a very big change, because right now at 400,000, you're actually in a 32% rate for married couples. Look at page 31, please. SALT deduction. Okay, so SALT comes back. What does that mean? Let me make it real easy. You know SALT's coming back, and you have an estimate, a fourth quarter estimate for 2021. Do you pay that estimate in January or do you pay it in December? Obviously, you pay it in January. What about your property taxes, Marty? You can pay those in either December or January. Naturally, you would pay them now in January. And this is the kind of thing that's going to come back. Now, the question becomes, once we know this is coming back, do we forgo making state estimates, save them till January 1st, 2022, pay the penalty to the state, and still be able to deduct the core of the state income taxes? And that the answer to that is probably yes, but we have to watch what they do with the AMT, okay? Because state and local taxes have always been an AMT add back. That hurt a lot of people in the past. Let's look up at
Bob.
Yes.
Bob, if we're going to have a 28% cap on the effective benefit of itemized deductions and the P's limitations back, even if they restore the SALT deduction, aren't those going to kind of offset some of the benefit we would hope to gain?
Absolutely. This will be a mathematical nightmare for CPAs. They will have to work very hard to compute what's going to be the best thing for clients. And of course, it's going to be able to do that. To compute that won't be that hard once we know what's going to happen. But if they do not introduce SALT correction legislation until November, most CPAs, probably including myself, are going to be reluctant to tell people not to make their estimates, because some states, the federal government, basically charges you 2-3% if you're behind on your estimates in this interest rate environment. Some states have statutory interest rates that hover around the 6 or 9 or 12% range. That's going to get real painful. So we're going to have to be very careful with this. But everybody should put in the back of their mind, if we're getting close to legislation that would restore SALT, we may want to adjust to save those state payments till January.
Well, Bob, as you have pointed out, the restoration of the SALT, the state and local tax deduction restoration, is almost certainly to happen, at least in large measure, because the head of the Senate now, Chuck Schumer, is from New York. Nancy Pelosi, the head of the House, is from California, and they have to do it for their constituents. Now, whether they'll do it without a limit, as it used to be under the law, or they'll put a limit on, we don't know. But in any event, remember, you're going to be at about a 40% federal tax bracket, but your deduction is only worth 28% because that's the maximum benefit you can get. And you have the P's limitation involved. Maybe you're down to something like a 25% effective rate, which means you're only getting basically 5/8 of the benefit of what you pay. And that may mean that, and I think we'll know when it's going to happen. It may be that they'll try to restore it even for this year, because they want to go back and allow that. So you've got to really, for everybody on the phone, you're going to be in this kind of position if you're in a state where you have state income taxes, or you have, like Bob and Marty do, very valuable homes where you pay very large real estate taxes. You're going to have to watch this like a hawk and determine, do I pay it in 2021 or do I wait until 2022?
What about these these bait programs where states have provisions so your flow through entity can pay some portion of your state tax and convert it to a federal deduction or the equivalent of a federal deduction? What do we do with that?
For the time being, you leave it in place.
Yeah, but I don't think an awful lot of states, Marty, have. I'm still waiting for New York to do it. Because, you know, if you have a business and they impose a tax on the business itself, you get a deduction. You're not limited to the SALT limitation of $10,000. And number two, it may be a business expense, and therefore you're not going to be limited to 28%. That will be another factor to consider. Now, by the way, even though we think we're so clever because we've thought of this, the people who write these laws, the people on basically the Ways and Means Committee and the Senate Finance Committee, are very smart people, and they will think about that, and they'll put in rules to try to thwart gaming to the extent that they can, so do that politically.
I was just kind of sitting back here and listening to you guys talk and just pondering how incredibly complex just this one piece of the puzzle could be, and how complex how we structure gifts this year will be. The amount of complexity that will be introduced by all of this and planning for it is remarkable. Bob, you want to talk a little about the P's limitation?
Sure. Basically, what P's did, it said if your income was over a certain threshold, for every dollar of income, you would lose 3 cents of itemized deductions, and it would have you could lose up to 80% of your itemized deductions. This is a pretty big deal. And this will come back probably at the $400,000 level. So if I made $500,000, Marty, I could lose $3,000 of my itemized deduction, which would basically, at a 40% rate, cost me 1.2%. So it kind of adds about 1% to your income. And you have to watch out for this, for example, when you're doing Roth conversions, because you're going to have a higher effective rate, because for every dollar of Roth conversion, you'll lose 3 cents on your itemized deductions. So we're going to have to learn all this new math very quickly. The good thing is most of it's pretty simple algebra, and CPAs will come up with rules real quick. Now, speaking of rules, right now 199 Cap A is extremely generous. And if somebody made $10 million, they would probably only pay income tax on $8 million. The Biden administration, and they haven't shown their cards on this, but they basically said, hey, we are going to, once you get to 400,000, we're going to cut back some of your 199 Cap A deduction. So we don't quite know what that looks like yet, but that will be out there, and it's a big deal. And let's go up to the next slide.
We're all set. Jonathan, I think we should transition and for just maybe the last 5-10 minutes, talk about some of the planning. I think we emphasized and explained in detail how the transfer documents on estate planning we're going to propose to clients now are different. But why don't you just speculate? What should advisors be telling their clients in addition to the idea that any gifts you make, you may want a formula disclaimer or QTIPable arrangement in case of retroactivity? But what should we be all telling clients that haven't yet planned that they should do?
Well, Marty, as you were indicating, one of the things that people hesitate to make gifts is that they can't benefit from the property once it's given away. I mean, maybe you can convince your children or your spouse or whatever to disclaim, but assuming that you really want to use it, you don't want to get it back, you want to use the exemption, or maybe you want to give away more because you think that the gift tax rates are going to go up in the future, estate tax rates are going to go up, so you're willing to give more even if you incur some expense in doing that. one of the ways to do it and kind of benefit from it is to create a trust for your spouse, known as a spousal lifetime access trust. Some people think it means a spousal limited access trust, but it can be a full-blown trust for the benefit of your spouse. And people have in the past, my wife and I did this in 2011 and 2012. You create a trust for your spouse, she creates one for you. If you want to do that, you've got to be extremely careful not to run afoul of the reciprocal trust doctrine. Because if they change who is the real grantor, it's going to wind up being back in your estate. And we spent a lot of time on that. There's a fair amount written about it. But Marty, I don't know if you've said that we're going to come back and have some really in-depth webinars, 2 hours just on estate planning side and 2 hours just on income tax side, because we haven't really allowed ourselves to get our teeth fully into these things. I mean, Marty, you and I know we could spend an hour on slats alone.
Let me ask you a slat question that I just thought of. And Bob, you may want to comment too. So one of the great ways to differentiate spousal lifetime access trust is spouse one creates a trust in January. Maybe you can still get it done in time. There's 3 weeks. We did stuff faster the end of last year. Do you have the other spouse wait till February, March, April? Or, and this is something that's sort of a new calculus for 2021, you say, you know what, I'm going to build in other differences in terms of assets, trustees, governing law, terms of distributions, and so on. But I want both of the spouses to get them done as soon as possible. And I'll take the risk on the reciprocal trust doctrine of them being done at the same time, because my bigger concern, and this is a question, not a statement, my bigger concern is, gee, we don't know when they're going to pass new tax legislation. How do you sort of evaluate or weigh the calculus of that now?
Well, Marty, one of the things I think you need to do is to consider an alternative. One of the things that I wrote about in February 2019 with Abby O'Connor and Mitchell Gans was about something we developed called a SPAT, a Special Power of Appointment Trust. So my wife, Betsy, creates a SLAT for me. It's a trust for my benefit. I do not create a SLAT for her. What I do is I create a trust for my kids, but I give 3 people, let's say it's Mitch Gans, Marty Shankman, Bob Keebler, as holding a lifetime special power of appointment in a non-fiduciary capacity, which would allow them to appoint any property in the trust to me or to my wife. And in fact, because I think that Marty might try to hurt me because I always catch bigger fish than he does, he says, well, Jonathan, I'm going to screw you because I'm going to give it to your grandson or something. I'm going to say he can only exercise that special power with the consent of my lawyer. And I think my lawyer, if Marty comes in and says, you know, Jonathan keeps out fishing me, I'm going to screw him by going ahead and pointing this to his grandson, James, I think my lawyer will say no. That's probably the best way to differentiate. It's not the same kind of trust. It's not even a self-settled trust, even if you try to put in the reciprocal trust doctrine. It's very worthwhile. Now, remember, I'm the sucker who developed the concept of domestic asset protection trusts in Alaska in 1997. But I think the special power of appointment trust, and I hope you're listening very carefully, is the cat's meow. So don't try to do 2 non-reciprocal slats. Do 1 slat and then do a spat.
We're going to go through all that in a deep dive follow-up program. But the point I wanted to raise is 2021 is unique in a number of ways. One, we talked about in depth that you may want a provision to unwind or make not happen a gift using formula disclaimers or something like that if there's retroactivity. But this is another concept. We don't know when the tax law changes will be. And I think we want to get clients that do want to do planning now to do it as fast as they can, and maybe trying to differentiate slats based on time is just not the best use of planning options. So just, again, it's something different, something to think about. I think we should try to wrap up, and hopefully we've given everybody a lot of both income, estate, and some general planning concepts that show why 2021 is unique. Bob, you want to make some final comments and recommendations to practitioners?
Well, I think time is of the essence. We know that. The person that's going to get hurt here is the person that stands still. So we need to find a way to move forward with reducing the risk. And those are the things Jonathan spoke so well about, as far as how do we do a laundry type clause, a formula type clause? How do you use a QTIP? How to use some type of overflow with a disclaimer? Those are going to be the things we have to look at. For the lawyers, if you are not going to be doing these gift tax returns, kindly insist on looking at them before they're signed and they go out the door, okay? Because really it's in the best interest if the lawyer and CPA, play nice together on that. And for CPAs, your risk of a mistake goes way down once the lawyer starts laying eyes on those documents. Because together, I've done a lot of expert witness things, but never against the Lone Ranger and Tonto. It's always against the Lone Ranger. So have the lawyer be part of that process, please. Now, when we don't know quite what the transfer looks like, we may struggle with doing the 2021 income tax returns that are going to be due in March and April of 2022. We'll figure out how to cross those bridges in the months to come, but sometimes a formula might not be quite defined, and we might not know how much S-Corp income goes to which trust, but we'll cross those bridges. Back to you, Marty.
So some of the future programs and articles that we have in the hopper to help everybody are going to address some of the things that Bob said. We're going to do a follow-up program at some point in the next few months, hopefully, on what you want to do to organize all the documentation from the massive amount of 2020 transfers that were done. Because good organization, a compilation of all the relevant documents, a schematic, a table of contents of all the documents, is something that will lay out what the tax return preparer, whether it's a CPA or the attorney, will need or should have to make sure they don't miss some of the nuances, which I've seen exactly what Bob has said. And it's not fair, frankly, to the CPA that an attorney does a very complex transaction, and sometimes the attorney, sort of led the charge on the transaction, and the CPA has brought in after the fact and said, here, do a gift tax return, and they weren't even involved to any significant degree. So organizing all those documents will help that, but I think just as important, it's going to help all of us, whatever discipline we're in, and the client, administer the plan. And even though we're going to all be, I think, inundated with 2021 planning, just like 2020, I think it's worth taking a breather and making sure that we focus on how to start guiding clients and all the advisor team to administer those plans correctly. So it looks like it'll be a challenging year, and we're going to try to keep developing materials to help with that. Jonathan, some last words and comments?
Marty, I just look forward to the future programs.
Bob, in my life, I've never seen Jonathan speechless.
Incredible.
I'm going to go buy a lottery ticket. Thank you, everyone, for joining us. Please keep in mind that the comments made were for educational purposes only. And I thank Jonathan Blattmacher, Bob Keebler, our sponsors, Peak Trust Company, and Interactive Legal, and also mention again the American Brain Foundation, a wonderful charity deserving of all of our support. Thank you for joining us, and good luck. And again, the handout materials will be made available along with a recording of this as well. And Jonathan has graciously offered to share his language for formula transfers, which will integrate into the slide deck. So you'll have that. And stay tuned. We're going to do a whole bunch of follow-up webinars as we all try to help sort out collectively what we need to be advising clients. And I'm sure whatever we lecture on will hopefully be helpful, but it'll also change as we start to learn more of what actual proposals are going to be. Thank you.